Tree Hotels Limited earnings conference call. As a reminder, all participants' lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note this conference call is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Lemon Tree Hotels Q4 and FY23 earnings conference call. We have with us today Mr. Patanjali Keswani, Chairman and Managing Director, Mr. Kapil Sharma, Chief Financial Officer, and Mr. Vikramjit Singh, President of the company. We would like to begin the call with brief opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation that was shared with you earlier. I would now request Mr. Keswani to make his opening remarks.
Thank you, Anup. Good afternoon, everyone. Thank you for joining us on the call. I'll be covering the quarterly business highlights and financial performance for Q4 this FY23, and then we will open the forum for discussion. FY23 has been the best year for Lemon Tree Hotels. As anticipated and in line with our initial guidance, we have more than doubled our total revenue versus 22 and have maintained a more than 50% EBITDA margin for the full year. In FY23, our overall total revenue increased by 111% versus FY22 to 879 crores with an EBITDA margin of 51.9%. Q4 FY23 was also the best quarter to date with growth across all metrics. As I had mentioned in the last earnings call, after increasing our ARR in Q3 versus Q2 23, in Q4 we focused on building occupancy, which increased by 604 basis points versus Q3 and 1,259 basis points versus Q4 FY20. Gross ARR stood at 5,824, which increased by 2% versus Q3 and by 29% versus Q4 FY20. This translated into an improved RevPAR of rupees 4,287, which increased by 11% versus Q3 FY23 and 55% versus Q4 FY20. In Q4 FY23 versus FY20, Lemon Tree Hotels RevPAR grew by 55%, whereas according to STR, the branded hotel industry grew 41%. The net EBITDA margin for the company in Q4 23 was industry leading at 55.7%, which increased by 146 bps versus Q3 and by 1926 bps versus Q4 FY20. The PAT for Q4 FY23 stood at 59 crores, which increased by 22% versus Q3 FY23. In Q4 FY20, we had a negative PAT of 19 crores. Our cash profit stood at 82.5 crores, which increased by 14% versus Q3 and by 845% versus Q4 20. As of 31st March 23, our gross debt stood at 1746 crores and the overall average cost of borrowing stood at 9.08%, while the weighted average cost of borrowings for the full year was 8.38%. During the quarter, we signed 9 new management contracts and franchise contracts, which add 538 new rooms to our pipeline. As of 31st March 23, our operational inventory comprised 88 hotels with about 8,400 rooms, and our pipeline comprised of 42 hotels with about 3,300 rooms. This quarter onwards, we'll also be reporting our total management fees received by Lemon Tree Hotels. In FY23, it was 104 crores, which increased by 54% versus FY20. To further explain, total management fees can be broken into 3 parts. The management fees that Carnation Hotels, which is our 100% subsidiary, receives from third-party hotel owners. The brand fees, which third-party hotel owners pay directly to Lemon Tree Hotels. And finally, the management and brand fees, which Fleur Hotels, which is our asset-owning joint venture with Dutch pension fund manager APG. This management and brand fees is paid to Lemon Tree Hotels by the joint venture. For FY24, I will refrain from giving specific guidance other than saying that our growth momentum is continuing and that we will be investing significantly more than normal in renovating our hotels, especially the Keys portfolio, to catch up with the near absence of this during FY21 and 22. This will increase our operating expenses by a further 2 to 2.5% on revenue basis for this year, but will position our hotels to capture better pricing and demand in H2 and in the following years. Finally, post-COVID and with the impending opening of our largest hotel, Aurika Sky City in Mumbai, we would now like to share the roadmap for the next 5 years, which has been released alongside the earnings presentation, where we have set forth clear and highly achievable outcomes for the next 5 years, wherein we intend to deliver superior financial performance, lighten our portfolio, be debt-free, and be a leader in digital and ESG. I would request everybody to look through that presentation. And on that note, I come to the end of my opening remarks and would ask the moderator to open the forum for any questions that you may have.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask question, please press star 1 now. Take our first question from the line of Archana Gude from IDBI Capital. Please go ahead.
Hi, good afternoon, sir. Thank you for the opportunity and congrats on very robust numbers. Sir, 3 questions. Firstly, I do understand you said that you won't be giving any specific guidance. Still, how the trend is looking, and I heard your interview on CNBC wherein you spoke about next 2 years to be, better for the industry. So, how we should look at it from top line and margin point of view for Lemon Tree?
See, what we are looking at is leveraging 4 separate revenue streams without significantly or in fact even, without really increasing our costs. So the first is we will look at improving our occupancy and ARR in the portfolio of Lemon Tree hotels and Red Fox hotels. So that is one lever we are looking at, which means really we are looking at increasing both the occupancy and the ARR in this portfolio. Then now that we have started a large-scale renovation, and that includes the Keys portfolio, we expect we will be able to command significantly higher ARRs and occupancies in the Keys portfolio, which, as you know, Archana, is about 18 to 19% of our total portfolio. That will see a significant uptake from H2 this year. The third lever is management fees. We have very aggressively added hotels, and in my presentation you may have seen that we expect to close this year with over 10,500 operating rooms, which is a fairly large hike from the 8,400 rooms that we operate now. Now this increase, about 670 rooms will come from this Aurika in Bombay, and another 1,400 rooms will come from hotels under the management and franchise contract, which we will operationalize this year. So management fee income we expect will see a significant hike this year and an even larger hike next year as these hotels then start operating for the full year. We capture the fees for the full year rather than part year when we open it this year. So put together, and of course the fourth is Aurika. So put together, what we see is across all these 4 revenue streams, there should be increasing traction, and I reckon that by this year and by the following year, you will see a material change in our revenue and EBITDAs. And as you note that we have said that we will look at maintaining these EBITDA margins at 50% at least.
Right, sir. Sir, you would like to upgrade that 50 to 55 now, since there are too many growth levers for us now?
Update you on?
So earlier we were talking about 50% EBITDA margin for us. Now since Q4 we had way better margins. Should that be the benchmark going ahead?
No, that won't. See, the benchmark is that, remember the H1 is always in revenue terms, anywhere from 42 to 45% of the annual revenue, whereas your costs are more or less fixed in this, your costs are allocated across the year. So the way to look at it is that EBITDAs in summer, whatever EBITDA margin we report, typically in winter we do 10-15% better than that. And that you would have seen in the past year, and that you can safely assume for the future years.
Sure, sir. Sir, on our Lemon Tree 2.0 guidance of 20,000 plus rooms and 300 plus hotels, how we should look at, look brand-wise growth or some color on region-wise expansion? Any particular brand to take precedence or any particular market you would give preference going ahead?
So think of it this way. Typically, management contracts capture 1/6 of the EBITDA of a hotel. So basically, if I manage 600 rooms, I basically take the EBITDA of 100 rooms. Okay? Franchise, you normally take the EBITDA of 1 out of 9. You take about 10, 11, 12% of the EBITDA. So in franchise, we normally, out of 900 rooms, capture the EBITDA of 100 rooms. Now, the issue with many hotels we looked at is that they are not coherent as far as product standards go with the Lemon Tree brand. So in that sense, Keys is a soft brand, which means really that we provide sales, marketing, distribution, our brand, and we give certain standards which are more service oriented to these asset owners. And therefore, the way we look at it is most management contracts will be signed by Lemon Tree, and most franchise contracts will be signed under the Keys brand. So while I cannot give you a breakdown, my broad expectation is that the rate of growth of franchise within the next year or two, since we've just started this, will start accelerating and will far exceed the rate of growth of the management business. Now, when I look at our portfolio, in FY24 we will open roughly 1,600 rooms, 26 hotels under the managed/franchise route, and another 670 rooms of Aurika. So really, that is why I said we will end FY24 with at least 10,600 operational rooms and about 115 operational hotels. Now, up to the end of last financial year, the end of Q4, we had already signed another 1,000 rooms which were due to open after FY24. And in FY24, we are reasonably sure we will sign another 1,500 rooms. So put together another 2,500 rooms. So our portfolio, which is why I have shown in the first slide of our 25-year roadmap, that we will hit at least 13,000 rooms by the end of this year. And this should, we have made fairly conservative estimates that we'll add only 2,000 more rooms a year, and therefore cross 20,000 by 28. So that's how we are looking at it. We will end this year, this FY24 with, owned hotels will be only 54% of the portfolio. And if I include signed hotels, then it will be 45% of the portfolio.
Mm-hmm. But is there any brand preference when we go for expansion for management contract, or it's like,
no.
It's as for the...
See, we were earlier a little reactive when we were letting owners reach out to us. Now that we have proactively set up a management, two business development departments in management and franchise, it is not based on let's put it this way, it's not that we say we want more Keys franchise or more Lemon Tree management. We are open to both. We just want to expand the network and achieve some level of what we call dominating scale in the mid-market. So it would be either, whatever is suitable for the relevant hotel.
Sure, so that answers. And so lastly, if I may, so how much is the capital expenditure left for Aurika Mumbai? And also given that we are now focusing on renovation of Keys portfolio, how much would be the total CapEx for FY24 and 25?
So about 75% of the renovation expense will be within the OPEX and therefore will be expensed before we get to net EBITDA. So when I said 2.5%, of increase in revenue, I really said about 25 more crores we will spend than normal. So looking at it from that perspective, last year we spent about 20 crores, including CapEx. This year we will spend about 55 crores, of which about 40 crores will be, or 43 crores will be OPEX, and that will come pre-net EBITDA. So in the CapEx sense, the CapEx will only be 10-11 crores. As far as Aurika Bombay goes, we have accelerated the deployment of capital because we are going to open it, as I said, in October this year. So we closed it at how much? 575? As of 31st March, it was 575, but we have already deployed another 80-85 crores. So it is now about 650 crores. So that leaves about 300 crores for opening that hotel.
Sure, sir. So thank you so much and all the best.
Pleasure, Archana.
Thank you. We take a next question from the line of Kaustav Pawaskar from Sher Khan by BNP Paribas. Please go ahead.
Yeah, good afternoon, sir. Thanks for giving me the opportunity and congrats for good set of numbers. So my question is on the EBITDA margin front. So you just mentioned that you would be spending around 2 to 2.5% of additional on the renovation, which will be part of your OPEX. And normally renovation happens during the first half of the year, largely in the quarter 2 when it is a lean business period for you. So considering that, should we expect that in H1 FY24 your margins would be lower on YOY, despite the fact that we should expect better occupancies on YOY and ARR, the higher OPEX would lead to lower margins, and in the second half of the year it should more or less normalize, so that for full FY24 you'll be having similar kind of margins what we have achieved in FY23.
So without comparing it to H1 of FY23, let me just say that whatever margin we do show from Q1 and Q2 is going to be 2.5% less than what we would have done if we had not done this extensive level of renovation.
Right.
Having said that, let me also add that we expect this to give us much better results in H2. So as a company, on a full year basis, the EBITDA margins will be 50% or more, number one. Number two, the other thing that can affect our EBITDA margins is the opening of Aurika Mumbai. Now when Aurika Mumbai opens, it will be opening in October. And October and up to middle of November is a very light period in India for demand because it includes Dussehra and Diwali, where many people do not travel. So what we expect is in Q3, Aurika Mumbai will take time to stabilize, and real stabilization will happen in Q4. As a result, on a standalone basis, Aurika Mumbai's EBITDA margins will certainly not be 50% and so on, especially when we launch the hotel. And therefore, that will act as, while it will increase our revenue and our EBITDA, it will not be at the ratio of the other hotels, and therefore it will also have an impact on our EBITDA margins in Q3 and Q4 as a percentage. But obviously, in absolute terms, it will be an addition to our EBITDA.
Got your point, sir. Got your point. So, FY24, so whatever benefit because of the renovation and Aureka, in terms of, when it will be fully operationalized, the benefits would start kicking in from FY25 for Keys as well because of the renovation, and Aureka would be fully operational. So, you will be having, more better revenues and margins from that particular property. Is it the right
Right. But Q4 may still surprise.
Okay, got your point. And so my second question is on debt part. So when do we expect debt to pick out, and we should start seeing some bit of reduction in debt, maybe from FY25 or 26. Any target or guidance on that front?
See, I had given one guidance once that we think that Lemon Tree Hotels standalone will be debt free by FY26, and in the very worst case, Fleur will be debt free by 2 years later, by FY28. However, if we have tried to give in our 5-year roadmap an indication of how we expect Aureka to perform, and I have specifically mentioned it is a conservative estimate. So Aureka in and of itself has the ability to generate 600-700 crores of EBITDA after fees to Lemon Tree in 4 years. So my view is that you will start seeing significant debt reductions from next year.
Okay.
So
Thank you, sir. Thanks for the opportunity.
See, this Kaustav is the peak of our capex. You have to keep in mind that we were deploying capital, enormous amounts of capital over the last 8 or 9 years. 40% was deployed and not CWIP till 1 year before COVID. Another 40% 1 year before COVID, and the last 20% is this year. So from next year onwards, obviously we have zero requirement for capital. We will only be looking at EBITDA as a way to reduce the debt.
Absolutely. Thanks for the explanation, and all the best for the future. Thank you.
Thank you.
Thank you. We take the next question from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, am I audible?
Yes, you are, Adhidev.
Hello.
Yes, sir,
Yeah.
you are.
Sir, I just wanted could you, sir, give us some sense for the EBITDA breakup for 23? How much is non-Fleur and how much would be Fleur EBITDA breakup of the portfolio?
So when we say we do 450 crores, really our EBITDA at the hotel level is about 16 crores more. So about 510 crores. No, there is fees also transferred, no? Yeah, so say about 550 crores. Now, I would say Lemon Tree on a standalone would be about 175, and 375 would be Fleur, or 350 would be Fleur. And then there is, when we report consolidated, A cancels B, which is why when we decided we would show this year the management fees that flow into to Lemon Tree standalone even from Fleur, because as you may have seen in our 5-year roadmap, we tried to show that we would be lightening our ownership of Fleur and progressively moving more and more towards a brand / manager of hotels. So I'm asking, Inder, can you do a breakdown of this in FY23 and let me know? Can I answer this in a little while, Adhidev, because we just have to calculate it.
Yeah, sure. I just wanted that to understand. Just to follow up, post the buyout of the CCDs in the last quarter, so what is, for the housekeeping agent, what is our share and APG stake now in Fleur Hotels?
APG, no, now at 41. No? Yeah, it is now at 42 and it will come down to 41%, which was our shareholding pre-COVID.
Okay. Sir, and just another question on you mentioned about the possible IPO or REIT InvIT listing for Fleur Hotels subsequently a few years down the line. So in terms of timing, would you, because considering the market scenario, so you mentioned 600 to 700 crores of EBITDA, right, for the Fleur portfolio or the Aurika portfolio, just to, if I'm not wrong, in your earlier comments.
In a broad way, look, we have a plan. Our plan is very simple. Irrespective of anything else, we feel without any other intervention, we will be in a position to be debt-free in the next 5 years, irrespective of any external intervention. Now, to come back to your earlier question, I've got exact numbers. So we did a total EBITDA of about 460 crores last year. Our share of that EBITDA was 350 crores. And APG's share of the EBITDA was about 110 crores. Okay? So if I look at it from the perspective of your question, the EBITDA of Fleur was about 320 crores. 60 crores went as fees to Lemon Tree, and I'm giving you approximate numbers for a flavor. So net EBITDA of Fleur was about 260 crores. Lemon Tree's owned assets did 100 crores of EBITDA, net EBITDA. They did another 60 crores of fees from Fleur and another little under 40 crores of management fees. Therefore, Lemon Tree did 200 crores, Fleur did 260 crores. And APG's share of that 260 was 110. Does that answer the question?
Yeah, sir. So broadly, it's a 75-25 breakup, right? If I just look at Lemon Tree and APG share, right? If I look at it that way, at the overall level.
So now let's go forward. In debt, the maximum debt is in Fleur. So if I look at it from the debt perspective and say we have 1,700 odd crores of debt, about 70-75% is in Fleur. Okay? So let's assume in a scenario that Aurika opens, we expect that Aurika net of fees will be at least 150 crores of EBITDA. So where is that figure? So the earnings on a standstill basis, if we just went by 260 crores of EBITDA of Fleur today, we are sure that this will obviously go up fairly significantly with Aurika Mile and the increase of the current portfolio and the increase of the Keys portfolio. So put together, if we look at listing it, the net EBITDA should be north of 500 crores. So if we list this company, hypothetically, and you can apply whatever multiple you want, we are going to be 59% shareholders. If we do a fresh issue of say 18% and come down to 51, then 18% means really that's fresh money on a company that has an EBITDA north of 500 crores. We feel that in and of itself may be enough to write down the debt of Fleur. So there are multiple levers. We have not, started exploring those routes. Right now we are saying on our existing portfolio, we will be debt-free even if we don't list Fleur. But obviously we would like to list Fleur. We would like to reduce our ownership in Fleur. We would like to increase our fee-based income. So there is an entire plan, and that's the real plan, which I cannot share with you. You will just have to keep seeing it play out with the 5-year plan that we have given out. So we will do an annual report as to where we are in this 5-year plan. So you see the path that we are following.
Okay, so all this is very helpful. Yeah, thank you and all the best.
Thank you.
Thank you. We take the next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yeah, I couldn't hear your name. I'm sorry. Can you repeat it?
Yeah, I'm Tushar Sarda.
Tushar. Okay.
Yeah. So thanks for the opportunity. I had two questions. One, you said that, on Keys you are going to spend money and bring them up to standard. If I remember in the past calls, you